So I think gold will drift sideways to the end of the year. And then as we go into Christmas, it will start to anticipate the buying from investment managers next year. And then we'll start to see a recovery. Probably, in my opinion, and this is not investment advice, but in my opinion, I think it's quite likely we'll break the all-time high of 4,400 and something, and probably move higher throughout the year.
So I think what the trigger might be next time is one of two things. Either the stock market rolling over so people with profits in NVIDIA and Microsoft start to look for somewhere else to put their money, or it could be a pickup of inflation, because people think of gold as an inflation hedge. You ask 100 people in the street, they'll say, oh, well, gold is a good inflation hedge. We can debate that, but that's what will make people buy gold, I think.
It's not retail traders or central banks that could spark the next big move in gold. It's Wall Street itself. Legendary analyst Clive Thompson says large investment firms are finally preparing to include gold in their portfolios next year. The numbers make the case clear. Portfolios with gold have outperformed those without it, delivering stronger returns and smoother performance through volatility. The data is too compelling for big money to keep ignoring. But Thompson explains that for institutional investors, shifting into gold isn't a quick decision. There's a long, bureaucratic chain of approvals. First, the investment committee decides what kind of exposure they want: physical gold, mining stocks, or ETFs. Then come the lawyers and compliance officers, making sure the move aligns with regulations. If they choose physical gold, storage and custody become another major hurdle. Because of these layers, even if the decision has been made, the actual buying won't show up in the market until late this year or early next. That's why Thompson expects gold prices to move mostly sideways for now. Once institutions begin reallocating, though, the inflows could push gold beyond its previous high near $4,400 in 2026. Silver, he adds, is driven by a different engine. Its price depends less on Wall Street and more on industrial demand, from solar panels to electronics. Global silver consumption now exceeds mine supply, and with technology demand accelerating, that shortfall keeps widening. When the next leg of institutional buying begins in gold, silver could ride the same wave, only faster and more violently. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Gold's come off quite a bit. It was at 4,400. It's below 4,000 now. It's 3,966. It could easily retrace to the 3,500 level. I think that we go down, or I don't say we go down. We don't know if we're going to go down. I think we probably go sideways for a while. My best guess is another month and a half of that, 2 months nearly. I think we go sideways for a while as we go into the run-up to Christmas. But next year, a lot of investment firms will be wanting to put gold in their asset allocation, because the maths will prove that if you have some gold in your asset allocation last year and last few years actually, it would have improved returns and it would have reduced volatility. Now, it takes a long time in most large companies to change your asset allocation table, because you've got a lot of things to do before you can it's not just one guy sitting at the top of the pile saying, oh, let's add gold. You've got to go through a lot of different departments. You've got to go through the legal department, the compliance department, the risk department, the custody department. I mean, just as an example, if you decide to add gold to your asset allocation, the custody department has got to, well, let's start with the investment management department's got to decide, how are you going to put gold in the portfolio? Will it be gold mining shares? Will it be physical gold? Will it be gold in an account? Will it be a gold exchange traded fund? Will it be some sort of customized instrument? They've got to decide how, and then the legal department's got to take a look at it and say, is this legal? Is this allowed by the investment management rules of our country? And then you've got the compliance department looking at it. And then you've got the safe custody department saying, well, if we decide to buy an exchange traded fund, who are we going to custody it with? How are we going to do it? Is it safe? Have we got the right agreements in place? If it's gold, physical gold bars, again, another problem. How do we do it? Where do we store it? So there's a whole raft of departments get involved if you change the asset allocation. That's why firms which are thinking about doing it will still take some time, but the target for most of them will be to get this gold probably as part of their asset allocation for next year, and they'll be announcing that asset allocation towards the end of the year. So I think gold will drift sideways to the end of the year, and then as we go into Christmas, it will start to anticipate the buying from investment managers next year, and then we'll start to see a recovery. Probably, in my opinion, and this is not investment advice, but in my opinion, I think it's quite likely we'll break the all-time high of 4,400 and something, and probably move higher throughout the year. Just my guess. Similar considerations apply to silver, though it's much more driven by the private investor than large institutions, which aren't really putting silver into their portfolios. But the other side of the silver drive is coming from the industrial use, where we know the industrial use exceeds the mine supply, and of course we've got electronic use increasing a lot. What we're looking at there is the silver miners exchange traded fund, and we look at the gold miners exchange traded fund as well. Both of these are off a lot this year, or not this year, but they're up a lot this year. But for example, take the gold miners VanEck gold miners ETF known as GDX. It's come off from a high of about $85 to $69. So big decline since the peak. And that's because the gold price has come off from the peak, and people are saying, well, my God, it's going back to 2000. I don't think that's the case, but certainly lower is likely, and that does mean that the short-term traders jump in and out of these gold mining stocks very, very fast. My strategy on gold mining stocks is just hang on to them. I think it's my personal view, many of the stocks I've looked at are not reflecting a gold price of $4,000, for example. They're reflecting something in the range of $2,500 to $3,500, typically $3,200, something like that. So they're not. The price of the shares is reflecting a reality of 6 months or a year ago, not of today's gold price. Now, of course, you can take a view, well, today's gold price is going down, or you can take a view it's going up. But if gold price stays where it is, a lot of these gold mining companies are rather undervalued compared with where they should be next year, assuming the gold price stays where it is, and they can mine all this gold and sell it at a higher price than they sold it for last year.
Adrian Day of Adrian Day Asset Management says gold's recent pullback shouldn't surprise anyone. After several years of steady gains, the metal simply needed a breather. What's important, he says, is to recognize that this doesn't look like a market top. True peaks, like those in 1980 and 2011, come when everyone is talking about gold, when it floods the headlines, and when ordinary investors rush in out of fear or greed. None of that is happening now. The sentiment remains calm, even cautious, which usually signals there's still room to run. Day notes a clear divide between Western and Eastern attitudes toward gold. In places like Germany, Italy, India, and the Middle East, owning gold is seen as a form of generational security. Families remember what currency collapse and inflation feel like, so they hold gold instinctively. In the US, it's different. Americans generally see gold as a trade, not as protection, something to buy only when markets get rough. As for what could reignite momentum, Day sees two possible sparks. Either the stock market finally weakens, pushing investors out of tech and into safe havens, or inflation ticks up again, forcing people to remember why gold has always been the ultimate hedge against uncertainty. Let's get back to the interview.
So, I mean, look, the truth is, and we all know this, even if we only know it in retrospect, but gold just ran up far too far, far too fast, particularly, since August. I mean, frankly, even if you look back at the last 2 years, it's been an extraordinary run for gold, but particularly in August and September, October, gold just moved too far, too fast. And you were beginning to see some sort of indications that we were going to have a temporary top. But I mean, personally, I just don't think it's anything to be overly concerned about. Of course, when you look at your statement and it's down 15% from what it was, a month ago, that is of concern. I don't think it's going to be a very shallow, I don't think it's going to be a very deep correction, but it's clearly, not clearly, but it's probably going to last, it could easily last a couple of months. But I say all that because, I mean, first of all, you have to look, is this a top? That's the fundamental question. Have we seen the top? And I think we are so far from a top, and there is just no evidence. When you're at a top, you get huge public participation. You get a manic feel. So you hear about gold at dinner parties. You hear about gold on CNBC every night. There's massive inflows into the gold funds. We haven't seen any of that. So I think we're so far from a top. And compare it with 2011 or 1980, where you could see massive inflows coming in at the top. We're not there yet at all. I think I think the Western investor typically will move into gold when the economic environment, when the economic factors favor gold. The North American investor, unlike central banks, unlike Chinese investors, Asian investors, Middle East investors, and even European investors, we have no real experience of gold being really valuable as an asset of last resort. In Germany, they still think about the Weimar Republic and the runaway inflation. Nobody alive today lived through it, but they still think about it. Their grandparents told them about it. Same with Italy, same with France. And of course, Hong Kong, people who fled from China carrying their gold to enable them to start life again. We just don't have that kind of experience in the U.S. And so in the U.S., people typically, they say they buy some gold for insurance, right? But it's just not in the DNA. Typically, people in the U.S. buy gold as an investment when the economic environment is right. And what that means is a weakening economy, low and declining interest rates, high and rising inflation, and a weak dollar. And until recently, the narrative, if not the reality, has been completely the opposite of that. And so if you think back a year with a strong economy and a strong labor market, solid, Jerome Powell told us, inflation coming down dramatically, and the dollar reasonably strong, that was not conducive to buying gold. So I think what the trigger might be next time is one of two things. Either the stock market rolling over so people with profits in NVIDIA and Microsoft start to look for somewhere else to put their money, or it could be a pickup of inflation, because people think of gold as an inflation hedge. You ask 100 people in the street, they'll say, oh, well, gold is a good inflation hedge. We can debate that, but that's what will make people buy gold, I think. It's perfectly normal in the middle of a bull market to have a significant correction. This really isn't even a correction yet. Let's not forget that. This is just a pullback. But we haven't had a correction in this bull market since gold bottomed well, if you go back just to 3 years, we haven't had a correction. And it's perfectly normal to get corrections. So you think back to 2006, where the price of gold dropped about 30% in a week. Does anyone remember that? I mean, nobody remembers that anymore. It's just a blip on the chart. Now, when you were living through it, it was awful. But it's just meaningless at this point. So these sort of things are normal. And so what you really have to decide, I'm sorry, this was a closing thought, wasn't it?
Keep going.
The thing you really have to decide is, do I think this is the top, like 2011, like 1980, and we're going to go into the wilderness for another 10 or 15 years? Or is it just a correction? If it's just a correction, you absolutely do not panic and do not even think of selling stuff after they've already dropped like this. And on the other side, I mean, if you really honestly think this is a top, I feel sorry for you, but there's no, seriously, what is the evidence for thinking this is a top, other than the fact that I remember 2011 and I don't want to live through it again? Well, that's, if I may, and that's what I hear from so many people, but if I may, that is not, rational analysis. That's just emotion. So if you analyze the market, what are the reasons to say this is the top? And in my view, there are no reasons whatsoever. The fundamentals are still positive for gold. The people who have been buying gold are still buying it for the same reasons. The reasons haven't gone away. The valuations of the gold stocks are still very, very cheap.
Every major turning point in the gold market starts quietly, with the biggest players moving before anyone notices. What's unfolding now feels like that kind of moment. Institutional capital, the slow, deliberate kind that reshapes long-term trends, is beginning to turn toward gold after decades of ignoring it. These firms aren't driven by hype or fear but by hard data showing that portfolios anchored by gold weather turbulence better than those without it. Once the bureaucratic gears finish turning, their entry could transform the landscape, soaking up physical supply and leaving less for retail buyers who hesitate. Meanwhile, silver stands ready to mirror and amplify that move, powered by industrial hunger and tightening availability. Together, the two metals are being quietly revalued, not by retail sentiment, but by global necessity. What we're witnessing isn't just another commodity cycle, it's the early stage of a structural reset in how wealth and security are defined. So when the institutional tide finally comes in and physical supply starts to tighten, will the average investor still be watching the charts? Or will they already have missed the quiet accumulation phase that changed everything? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.